Whether you trade stocks, ETFs or currencies, every trader needs a plan that tells you when to enter and exit a trade to make a profit. Welcome to the first of a 4-part series to show you how to use Theta 45 to create a trading plan. Click on subscribe and ring that notification bell so you don't miss future episodes. In this episode, we look at how to use Theta 45 to start your trading day with a high probability setup that evaluates the right financial instrument to trade. For day and short-term traders, you want to be in and out of the market quickly at the stated market price. In other words, you want a financial instrument like a stock to be liquid. A high average trading volume relative to other stocks is a good indicator of relative liquidity. Daily volatility is the percentage difference between the daily high and low price. Intraday volatility is the percentage difference between the previous close and today's high, low or close price. If your position target as an intraday trader is 1%, the probability of hitting your target increases if you have a larger board to hit during the trading hours that day. If you keep your position overnight, you want to select a stock where the high price the next day is much greater than the previous close. For those traders with a large position target, volatility is your friend. Theta 45 forecasts the next closing price within a standard deviation of 2 and within bands of a width of a standard deviation of 0.5. The signal risk screen tells you how often over the last 64 trading days did the high, open and close finish each trading day within each band of the forecast range or outside. The orange close histogram is an indication of how accurate Theta 45's forecast has been over the last 64 trading days. Therefore, you want to trade a stock where Theta 45 has come the nearest to predicting the next closing price for the majority of trading days. You also want to trade a stock where the high histogram is heavily skewed to the sell side on the right, and where the low histogram is heavily skewed to the buy side on the left. If you're going long on a trade, you want to buy within or beyond a band where there is no occurrence of a high price. Buying in a low band means there is a much greater probability that there will be a higher price to sell at either that trading day or the next. If you're going short on a trade, you want to sell within or beyond a band where there is no occurrence of a low price. Selling in a high band means there is a much greater probability that there will be a lower price to buy back your shares either that trading day or the next. Once you have selected a stock or any other financial security that provides the right amount of liquidity, volatility and signal risk, you need to manage your risk and protect your capital. Whether you trade stocks, ETFs or currencies, every trader needs a plan that tells you when to enter and exit a trade to make a profit. Welcome to the second of a 4-part series to show you how to use Theta 45 to create a trading plan. Click on subscribe and ring that notification bell so you don't miss future episodes. In this episode, we look at how to use Theta 45 to manage risk and reward in order to protect your capital against significant drawdowns. When you buy and own a financial security, you open a trading position. The position holding period is the duration of ownership before you sell. Theta 45 traders have a position holding period that ranges between seconds and the close of the market the next trading day. The position target is the predetermined return you wish to make before you sell the financial security and close your position. The price of a financial security, such as a stock, tend to change in small increments every second when the market is open. And therefore, the larger you set the position target, the longer the position holding period you will need before you can sell. As we saw in the last episode, you want to set a position target that is a fraction of the security's average daily high-low to have a greater probability of hitting your target. And to cover the risk of holding your trading position overnight, you want to select a security where the next day high is greater than the previous day's close for the majority of trading days. As a trader, you will use your available capital to buy a financial security. The position size is the proportion of your capital that you invest in each trade. Theta 45 traders are advised to set the position size by balancing the capital you want to risk per trade with the volatility or daily risk of the specific financial security you wish to trade. In this example, there is about a 95% probability that the price could drop down to 1.87% before the market closes that trading day. And if the price drops to that level after you buy the security and you do not want to risk more than 0.2% of your total available capital, you should set the position size to 10.7%. Now let us combine what we have learned in these two episodes to create a trading plan of 5 stocks. In episode 1, we learned that the best stock for day trading is one that is liquid, as indicated by a high daily volume. You want to select a security to trade that has a high daily volatility, so you have a larger dartboard to fit your position target. And finally, you want a signal risk histogram to be skewed to the right for the high prices and skewed to the left for the low prices. For each stock, you want to select a buy score where there is no corresponding high price. You can use the odd screen to convert each buy score into a buy price. You now have a price to enter the market for each stock. The daily risk is how much you're willing to lose on each trade, which is used to calculate the price risk or your stop loss. The capital risk per trade is how much of your total capital you are willing to lose on each trade. The daily risk and the capital risk per trade are then used to calculate your position size. The actual position size is dependent on how many shares you can buy at the given buy price. To determine the sell price, set a position target that is a fraction of the average daily high-low. The price target is your sell price to make a return equal to the position target. In this example, with this risk to reward ratio, only 19% of your total capital is invested if all 5 positions are bought. In the next episode, we combine what we've learned from the previous 2 episodes and backtest our strategy. Whether you trade stocks, ETFs or currencies, every trader needs a plan. That tells you when to enter and exit a trade to make a profit. Welcome to the third of a 4-part series to show you how to use Theta 45 to create a trading plan. In this episode, we'll look at how to use Theta 45 to backtest your trading plan. In the last 2 episodes, we used Theta 45's signal risk screen to determine our buy score, and then use the odds screen to convert the buy score into an actual buy price. But how can you as a trader be confident that this price is low enough to buy so that you can sell at a higher price, either that same trading day or by the end of the next trading day? You can use the volatility or the backtest screen to verify if the same strategy would have worked in the previous 64 trading days. Let's assume we use a simple passive trading strategy where we buy at a buy score of 75 for each trading day where the buy score hits 75 and above. The signal risk screen identifies how many trading days out of the last 64 when the buy score was 75 or more. The volatility screen allows you to identify at a glance on which days the buy score hit 75 or above. In the volatility chart, the buy score hit 75 or above on all the days where the volatility was -1 or below. You can zoom into this chart to see that the price was in the higher band either that day or the next when the buy score was 75 or when the volatility was -1 and below. Go to the backtest screen on these dates to find out what price you could have bought and sold to make a profit. Using the simple passive trading strategy, we buy when the price hits a buy score of 75. What we're looking for is a higher sell price, either that trading day or by the end of the next, for each date identified. In our third day, we get a loss when buying at a score of 75. This is because the general predicted trend in the market was downwards. To mitigate the risk of not having a higher price to sell, you should select a higher buy score. Or employ an active trading strategy and buy towards the bottom. As we cycle through the remaining days, using this strategy we break even on day 11. But then continue to be profitable for the remaining of the trading days when the buy score was 75 or above, giving this passive trading strategy a success rate of 87%. Instead of deploying all your capital when the buy score hits 75, you can use a staggered passive strategy. For example, you can deploy half of your capital if the buy score hits 75 and the remaining half if the buy score hits 87.5. Or split your capital into thirds and wait for the buy score to hit 100 before investing your final third. Alternatively, instead of dividing your capital equally for each band, you can weigh them and buy proportionately more shares as the price drops lower. While Theta 45's technical analysis alone can make you profitable as a day trader, you still need to know what information drives the price up or down for each trading day. In the next episode, we look at the information that will drive the price of a stock in the short term. Whether you trade stocks, ETFs or currencies, every trader needs a plan that tells you when to enter and exit a trade to make a profit. Welcome to the last of a 4-part series to show you how to use Theta 45 to create a trading plan. While day traders can be profitable using Theta 45 alone, knowing what drives the price of a stock on a daily basis increases the confidence in the technical analysis. In this episode, we're going to focus on stocks only. The stock price for a specific company has a long-term trend that depends on the persistent outlook of that business by the market. As a trader or investor, you buy a share of that company at the prevailing market price. As a shareholder, you are entitled to your proportion of the free cash flow generated by the company. The demand for shares will be greater for a company that generates increasing cash flows year on year, increasing its share price. Conversely, a company losing cash will have less demand for its shares, decreasing its share price. The share price can also be manipulated from the supply side, when the company either issues new shares, which drops the price, or buys back its own shares, which increases the price in the market. But the primary factor that drives the demand for a stock is the free cash flow the company can generate. Cash comes into a company in the form of sales. A healthy company will have increasing sales year on year. But the company has to spend cash to manufacture its products or to deliver its services. Taking an airline company as an example, these costs include labor, airline fuel, and aircraft maintenance. Subtracting these items from the cash received in sales gives us the gross profit. To generate the sales and support the business, a company also has SG&A expenses that include marketing, airport fees, and sales commissions. Subtracting these costs from the gross profit gives us the operational profit. A large company runs on debt and will have to pay interest expense every year. A company with spare cash, or a company who have to hedge against expenses that fluctuate in price, may also have to invest in financial securities that earn interest every year. This net finance expenditure is deducted from the operational profit to calculate the profit before tax. A company then has to pay the prevailing corporation tax in the jurisdiction in which it is registered. Deducting that gives us the company's net income. The net income is the cash generated from sales. But the company has other items on its balance sheet that can be converted into cash. The balance from the cash from operating activities, such as depreciation and amortization, inventory, and accounts payable, need to be accounted and added back to the net income to calculate the operating cash flow. Finally, for a company to grow and adapt to the challenges of the future, money needs to be invested in assets. Money can also be earned with the disposal of assets. The actual free cash flow is calculated by deducting the net capital expenditure from the operating cash flow. While the market has a medium to long-term outlook on the free cash flow a company will generate in the future, any daily news that goes for or against those market expectations will drive the price of the stock in the short term. This could be information that directly impacts the revenue or cost of the company alone, or news that impacts the local economy and therefore the market as a whole, or information that has an impact on the whole world, such as a global pandemic or war. Speaking of which, a global pandemic can cause an unexpected drop in flights, dropping the stock price. The cost of goods sold can take an unexpected turn for the worse if there is a spike in the oil price. Inflation can increase the cost of marketing, or airports can decide to increase their fees. And if a rise in interest rates is unexpectedly announced, the cost of financing can also increase. Cash flow can also be reduced if the corporation tax increases, all of which decreases demand for this stock, dropping its price in the market. Conversely, demand for the stock increases if sales improve, or if the costs of the company are reduced. Day traders need to be aware of any such news announced each day about the company they are trading. For example, Don't expect the price to come down on the day that a company announces an unexpected rise in net income. If you missed the trend going upward, either short sell at the top or wait for the price to settle or come down before buying. This is just one example of what makes a good trading plan. Subscribe to this channel as we will produce more videos on how to use Theta 45 to be a successful day trader.